Hello. As a professor of taxation, I've seen firsthand just how confusing the rules around selling your home can be for so many people. My goal today is to really cut through all that complexity and make these rules clear, accessible, and understandable for every single homeowner. So let's dive right in. For most of us, our home is by far our biggest and most important asset. And this idea that when we sell it, it's tax-free, well, that's a cornerstone of personal finance in Canada. But, and this is a big but, the rules are a lot more complex than most people think. So today, we're going to break down one of the most valuable and honestly one of the most misunderstood tax benefits out there, the principal residence exemption. So let's just start with the big question, the one that probably brought you here in the first place. Is the profit you make from selling your home truly tax-free? The answer you'll usually hear is a quick yes. But the real answer is, it depends. And it's what it depends on that can end up costing homeowners thousands or even tens of thousands of dollars if they're not careful. All right, so here's our game plan. We're going to start with a massive rule change that affects absolutely everyone. Then we'll decode the basic rules of the exemption and really get into the weeds on the most confusing part of the formula, what I call the +1 rule. After that, we'll look at some common and very costly mistakes people make, and we'll wrap it all up with how you can proactively protect that tax-free gain. First up, let's talk about the year 2016, because that's the year the entire landscape for selling a home in Canada changed. And I mean fundamentally. What used to be a pretty simple and frankly often unreported event is now something the Canada Revenue Agency, the CRA, watches like a hawk. Think about this for a second. Before 2016, if the exemption covered your entire gain, which it did for most people, you didn't even have to mention the sale on your tax return. It was pretty simple. But since 2016, every single sale has to be reported, even if you don't owe a dime in tax. This was a massive shift from a sort of don't ask, don't tell system to one of mandatory disclosure. And they are not kidding around with this new rule. If you fail to report the sale, you can face a penalty of $100 for every single month you're late, and that can go all the way up to a maximum of $8,000. This makes it crystal clear that reporting isn't just a suggestion, it is a serious requirement. But honestly, that penalty isn't even the main story. The really crucial point here is that by forcing you to report, the CRA now has a complete record of every single transaction. This gives them a perfect opening to scrutinize the sale, to ask questions, and to make sure you followed all the complex rules. Rules that, frankly, many Canadians might have broken in the past without even realizing it. So this brings us right to the heart of the matter. If every sale is now potentially under the microscope, we have to be absolutely crystal clear on what actually qualifies for this exemption in the first place. Okay, so the definition of a principal residence is surprisingly broad. It can be a house, sure, but also a condo, a cottage, even a trailer or houseboat. And here's a fact that always surprises my students. Your principal residence doesn't even have to be in Canada to qualify. The key legal phrase is that you have to ordinarily inhabit it. So, to qualify, you basically have to tick 4 boxes. 1, you have to own it. 2, you, your spouse, or your child must ordinarily inhabit it at some point during the year. And you know what? Even a short vacation can be enough to meet that test. 3, you have to officially designate it as your principal residence for the years you're claiming. And 4, this one is critical. A family unit, which means you and your spouse or common law partner, can only designate one property for any given year. You can't have one spouse claim the city house and the other claim the cottage for 2023. That hasn't been allowed since way back in 1982. All right, now let's get into the math. The formula for the exemption can look pretty simple on the surface, but it has one little element that causes a ton of confusion. It's called the +1 rule, and understanding this is the key to seeing how the exemption actually works in the real world, especially when you move. So here it is. This is the formula the CRA uses. Your tax-free amount is figured out by a fraction, which is then multiplied by your total capital gain. Now, that fraction is 1 plus the number of years you designate the property divided by the number of years you owned it. The whole goal is to make that fraction equal 1. If you can do that, your entire gain is completely sheltered from tax. To really get why that +1 is so important, let's first look at a case where it seems totally useless. Let's say you bought house A in 1988 and sold it in 1995 for a nice $100,000 gain. You lived there the whole time, so you designate it for all 7 years. If we just ignore the +1 for a moment, the math is 7 divided by 7, which is 1. Your full gain is exempt, no tax. Simple, right?
And this is the exact point where my students get confused. They look at that last example and they ask, well, if it worked out perfectly without it, why on earth does the +1 rule even exist? The answer becomes crystal clear the moment you buy a new house. Okay, so let's say in 1995, the very same year you sold House A, you bought House B. You hold it for 18 years and make a $40,000 gain. Now here's the problem. You already used your 1995 designation on House A, and you can't use it twice. So for House B, you can only designate 17 of the 18 years you owned it. If we do the math without the +1 rule, your fraction is 17 divided by 18. And all of a sudden, you have an unexpected taxable gain over $2,000. And this is where the magic happens. The +1 rule was specifically designed for this exact situation, the year you sell one principal residence and buy another. It lets both properties get treated as your principal residence in that one overlap year. So when we add that 1 back into the formula, we get 1 plus 17, which is 18, divided by 18, the fraction becomes 1, the full gain is exempt, and just like that, the taxable gain completely disappears. It's a tiny detail with a huge impact. Now that we've got the fundamentals down, let's move on to what I think is the most important section for most of you watching: the common and really costly pitfalls that can put this valuable exemption at risk, especially now that the CRA is paying so much attention. Okay, there's a key concept you absolutely have to understand. It's called deemed disposition. It's tax jargon, I know, but it's basically an event where the CRA considers you to have sold a property even if you didn't actually sell it and no money changed hands. And the most common thing that triggers this is a change in use, like deciding to turn your family home into a rental property. Let's just walk through a quick timeline. Say you buy a home in 1984. Then, in 2011, you move out and you start renting it to tenants. The moment you do that, bam, the CRA deems you to have sold it at its fair market value right then and there. Now, the good news is the gain up to 2011 is protected by the exemption, but any increase in value from 2011 until you actually sell it in, say, 2015 is now a taxable capital gain. So what about something smaller, like a home office or renting out a room in your basement? The good news is the CRA says they generally won't trigger that deemed disposition as long as you meet 3 conditions. First, the business use has to be minor compared to the personal use. Second, you can't make major structural changes like building a separate entrance just for the business. And third, and this one is non-negotiable, you cannot claim depreciation, which is called capital cost allowance or CCA, on that part of your home. The second you claim CCA, you're telling the CRA that part of your home is a business asset, and you can kiss the exemption goodbye for that portion. And there are a few other traps to look out for. If your property is on a really big lot, the exemption usually only covers about 1¼ acres of land. If you're flipping houses, be careful. The CRA can decide you're running a business and then your entire profit is 100% taxable as income and the exemption is denied completely. And please be very cautious about adding an adult child to the title of your home just to avoid probate fees. It might seem like a smart move, but it can create a massive tax headache down the road because your child might not qualify for the exemption on their share when the house is eventually sold. Okay, I know that was a lot of don't do this and watch out for that. So now let's focus on the solution. There are some really powerful tools you can use to protect your gain, but the trick is you have to know they exist and you have to use them proactively. So let's go back to that change in use scenario from your home to a rental. Here's the crucial point. You can file a special election with the CRA. This election lets you hit the pause button on that deemed disposition and continue treating the property as your principal residence for up to 4 more years, even while you're not living there. This can shelter tens of thousands of dollars in gains from tax, but it only works if you file that election on time. And that really brings us to the end. The principal residence exemption is without a doubt one of the most significant tax benefits we have as Canadians. But as you've seen, the rules are very precise and the stakes are incredibly high. So the final question I want to leave you with is this. Your home is likely your biggest asset. Now that you know the risks and the tools available, are you truly prepared to protect it? I certainly hope this has given you the knowledge to do just that. Thank you.